Hello, future investor. Welcome to your essential guide to investment funds. If you're just starting your journey in the share market, learning about funds is the most crucial first step. Simply put, funds are the easiest and safest way for a beginner to start building long-term wealth. Let's dive in. An investment fund is just a giant basket where thousands of investors pool their money together. A professional fund manager then takes this pooled money and buys a large, diverse collection of stocks, bonds, and other assets. The goal is simple. You get instant, broad ownership. Instead of buying shares in just one company, you instantly own tiny pieces of hundreds of companies in a single purchase. This is the golden rule of investing. Don't put all your eggs in one basket. Funds help you follow that rule instantly. Now, let's simplify the two main types you'll encounter: ETFs and mutual funds. First, exchange-traded funds, or ETFs. Think of an ETF as a basket that trades just like a single stock on the stock market. They are popular because they are often passive and have very low fees. Second, mutual funds, also known as managed funds. These are typically active, meaning a manager is constantly trying to beat the market. This effort comes at a cost, making their fees generally much higher. For beginners, ETFs are highly recommended. Why? Because of the power of passive index investing. Passive investing is the tracker. The fund simply aims to match the return of a major index, like the S&P 500. The manager's job is minimal, which keeps your costs extremely low. Active investing is the stock picker. The manager is paid a lot to try and beat the market. But historically, once you account for their higher fees, most active managers fail to outperform the simple, cheap passive trackers over the long run. Remember, fees are the biggest drag on your long-term compounding. Stick to low-cost passive ETFs to win in the long run. Practical, step-by-step guidance. Step 1. Open a brokerage account. This is your access pass to the market. Choose a platform that is secure and has low fees. Step 2. Choose your strategy. We recommend dollar-cost averaging, investing a fixed amount of money regularly, no matter what the market is doing. This takes the emotion out of investing. Step 3. Buy your first share. Search for the fund's ticker code, place your order, and you're an investor. The best funds for a beginner track the largest, most diversified indices. For Australia, look for an ETF like VAS, which tracks the 300 largest Australian companies. For the US and global exposure, you want funds that track the S&P 500, like IVV or VOO, to give you ownership of giants like Apple and Microsoft. The ultimate guru recommendation is a simple mix of Australian and global ETFs. This ensures you are diversified across the world's best companies for long-term growth. When choosing an Australian broker like CommSec or SelfWealth, look for one key term: CHESS sponsorship. This means your shares are legally held in your own name, providing maximum security. Remember the power of compounding and low fees. Get started today, invest regularly, and let time do the heavy lifting for you.